So January 14th, 2020, the date that some experts in the gold community have predicted, along with Shemitah, along with gold-backed yuan, along with gold-backed petro yuan, along with gold trade notes, along with gold-backed crypto yuan. I'm probably forgetting some of the more outlandish predictions, but January 14th has come and gone, and guess what? The Dow is still right around 29,000. The dollar still has not collapsed. The dollar index is actually above 97 at 97.39. I'll hit the refresh button just to see if it's changed. It was, I think, 97.4, I think, about an hour ago. So it's at 97.39. So we did not get a collapse on January 14th. I do not know why people keep listening to these people who make these outlandish predictions, but I'm not going to be one of them. I'm not going to stick my neck out there and make ridiculous predictions like that. My predictions, any of my predictions, will be a lot more measured than that. So the main reason I'm doing this live stream show is it was reported today by the Wall Street Journal in an article by Daniel Kruger that the Federal Reserve officials are considering making direct loans to hedge funds. And I wanted to just throw in my 2 cents on why, because I've been covering Repo Madness, and I created the phrase Repo Madness, even though it has tens of thousands or hundreds of thousands of hashtags and impressions all over Twitter and social media and what doesn't even really matter. Someone should make a t-shirt out of it. Someone should make repomadness.com and update all these articles and track this. It would be a potentially really popular blog website. But the Repo Madness clown show just keeps on getting more and more ridiculous. So not only is the Federal Reserve still discussing the permanent repo facility, and they're discussing a number of these permanent repo facilities, which in my opinion would add even more moral hazard to the system, like Fannie and Freddie, where hedge funds bet that they're going to get bailouts and large Wall Street investment banks bet that they're going to get bailouts. So they make even riskier bets with even more leverage, over 10x leverage for some of these hedge funds. But now it is reported with the Wall Street Journal article that the Federal Reserve is also, in addition to the permanent repo facility, now considering direct loans to hedge funds for repo. And the article on Zero Hedge, which is free, the Wall Street Journal one is behind a pay article, but the Zero Hedge article about this that came out a couple hours ago is talking about the Bank of International Settlements December 2019 quarterly update, which I talked about, where the Bank of International Settlements laid out a very controversial opinion, citing different sources and research that they've done. And Claudio Borio, who works at the Bank of International Settlements, also did a follow-up interview in Bloomberg talking about this. But there's more than one problem, in my opinion, from researching different angles of Repo Madness with the repo market. So it's not just the large banks who bought too many U.S. Treasuries in the last 12 months, hoping that they could sell them for a quick profit, flip them back to the Fed for a profit. So according to the Bank of International Settlements report that came out about a month ago, almost exactly a month ago, that there's multiple problems connected to the repo market, including hedge funds that overborrowed in repo and leveraged up on trades, and those trades have gone bad. So what I have there on the screen, I added a little bit. In my opinion, the fact that this story is coming out about the Fed is considering lending cash directly to hedge funds, this, in my opinion, confirms that there is at least one fairly large hedge fund. It's got to be fairly large, at least one large hedge fund that has either already blown up or is about to blow up and is sputtering now since September 2019 and is comparable, maybe even larger than long-term capital management. So I've talked about this for the last month or so, that I think the spike in the 10-year U.S. Treasury yield was connected to it. I think a hedge fund leveraged up, betting on Treasuries, got caught on the wrong side of the trade on the 10-year. Let me look at the 10-year U.S. Treasury. The 10-year is still, it was, I think, as high as 1.9 something, and it's down to 1.81%. But it got as low as 1.45% around, and there was a big rise up in yields in under 10 days. And in my opinion, that was because a hedge fund also, at least one large hedge fund, was caught on the wrong side of that trade with a massive amount of leverage. And we may not find out the truth. The Fed does not want us to know which hedge fund is, or hedge funds are borrowing that money, which large banks are borrowing from repo. And at this point, and I'm going to borrow Kyle Bass's famous phrase here about a rolling loan gathers no loss. I'm going to change the words a little bit and put it into repo. A perpetually rolled over term repo gathers no loss. This will be the game plan. The game plan will be the banks, the large investment banks and others who are borrowing in repo. If you see the amount of borrowings are moving from overnight into term repos. So the entities that borrow have more control over the money for longer periods of time. Now, not all that's hitting the Fed's balance sheet, though. So I'll read this Zero Hedge article. At the beginning of December, the Bank of International Settlements presented a formerly unknown explanation for the September repocalypse, or Repo Madness as I dubbed it, one which, in addition to, and actually if this keeps on going to tax season for 420, we're going to have the first ever Repo Madness, or Repo Madness, if it goes through 420. One which, in addition, Vice Chairman of the Federal Reserve, Richard Clarida, said it well. One which, in addition to a sharp drop in liquidity by the top 4 banks, was amplified by an imbalance in demand for repo by hedge funds. Quote, high demand for secured repo funding from non-financial institutions, such as hedge funds, heavily engaged in leveraging up relative value trades, end quote, was a key factor behind the chaos, said Claudio Borio, head of the Monetary and Economic Department at the Bank of International Settlements. The report also, if you did not read the report, I don't blame you. There was a section on repo, specifically about 4 or 5 pages 21 to 24, I believe, out of a 150-page document. And also, there were dozens and dozens of pages by the Bank of International Settlement article writers in different sections of the report talking about forward dollar swaps and their relation to repo, and how the Bank of International Settlements is truly worried about forward dollar swaps. And the amount of those has exploded. Also, I forgot to add this point that the Federal Reserve loaning directly to hedge funds for repo creates even more moral hazard. So in the same way that a permanent repo facility would create more moral hazard, so the investment banks or the hedge funds borrowing from a permanent repo facility would gamble that the permanent repo facility would bail them out with more leverage, would buy back the bad assets if they went bad. The loaning directly to hedge funds would be a similar concept of creating more moral hazard in the system. Okay, let me continue with reading the article here. The Bank of International Settlements finding was novel, also controversial because a lot of people don't agree with it. A lot of people like Luke Groman and others keep claiming it's only about selling U.S. Treasuries. So there's also problems with that, in my opinion, but I think there's other problems too, because the Bank of International Settlements in that long report spent a lot of time about forward dollar swaps, and they think that that's connected to repo as well. But there's problems with a lot of the other primary dealers and the large money center banks. The 4 large banks here in the U.S. are large buyers of primary dealers as well, and large buyers of U.S. Treasuries. But the other primary dealers are nowhere near large enough to afford to buy all the treasuries that need to be sold. And so to meet contractual obligations, I believe they also went into repo. So the problem at repo culminated, in my opinion, because a lot of entities that were having problems all went into the repo market to borrow at a very short amount of time. And now there's rapidly decaying collateral problems. Jeffrey Snyder has talked about this at length from Macro Voices and others. So there's a lot of problems connected to the repo market. It's not just the U.S. government selling U.S. Treasuries, massive amounts of them. There's more than that. Okay, back to the article. The Bank of International Settlements finding was novel and surprising as it highlighted the growing cloud of hedge funds in the repo market. And the Bank of New York Mellon was heavily involved in getting hedge funds into the repo market because they're the main custodian of the private tri-party repo market, because there was no market, I believe, 3 years ago. And in only 3 years, the Bank of New York Mellon turned this into $100 billion. I'm not sure what it is now, but they were saying a couple months ago on their website that it was $100 billion per month in repo transactions, where they took money market funds that were not supposed to be loaned into repo. But money markets are so desperate for more income because central banks have manipulated interest rates down due to financial repression, that the desperate money market funds were loaning into repo, and Bank of New York Mellon was heavily involved in this, allowing hedge funds to borrow that money, leverage it up, and then those trades on the leverage trades that could be 10x or more have gone bad. Listen to the Doug Noland interview that I did a couple weeks ago. He's worked in the hedge fund industry for 25 years, and he talks about how there's global repo problems. There's problems in the repo market in Europe. The Bank of International Settlements also talked about this. There's problems in Asian repo markets as well. Okay, back to the article. Highlighted growing cloud of hedge funds repo market, which in retrospect is to be expected. As we noted over a year ago, hedge funds such as Millennium, Citadel, and Point72 are not only active in the repo market, they are also the most heavily leveraged multi-strat funds in the world, taking something like 20 to 30 billion in net assets under management and leveraging it up to 200 billion. So leverage levels in perspective there. If you have 20 billion in assets under management and you leverage it up to 200 billion, you're 10x leveraged. If you have 30 billion in assets under management and you leverage it up to 200 billion, you're a little over 6x leveraged. So to put things in perspective, if you're an investment bank or a hedge fund and you go to 10x leverage, you can get wiped out fairly easily with an asset drop. It depends on how much the asset prices drop, though. So if they drop enough, you can get wiped out fairly quickly. So firms like Bear Stearns and Lehman Brothers, they also had problems with the repo market back then. Lehman Brothers actually had, if you want to go into it, Lawrence McDonald talks about this on his Twitter, that they had their repo pulled. I think Doug Noland also talked about this too in the interview a couple weeks ago that I did with him for my channel. But Lawrence McDonald was a vice president at one of the profitable arms in Lehman Brothers, not the one that was destroying the company, but the one that was consistently profitable every year. And he was talking about how Lehman Brothers had a 20 billion loan in the repo market and it was pulled. The Fed canceled it. And then they couldn't get any bailout and they couldn't. So Lehman Brothers was basically sacrificed and destroyed. But if you go 40x leverage, this is a hypothetical. If you're a hedge fund or an investment bank and you go 40x leverage on some of your trades or a large amount of your asset base, so your assets are 40x leverage, your company-wide balance sheet, it only takes a 2.5% drop in asset prices to wipe you out. And a 30 times leverage would be barely over 3% drop in asset prices. So the leverage can do immense damage the more you leverage up. Now, 10x leverage is not as bad, clearly, as 30x or 40x. But if asset prices drop, 10%, those companies are in big, big trouble. And there's going to be there's going to be volatility at some point. Okay, back to the article. In short, as shown in the chart above, some of the world's biggest hedge funds are active in the repo market to boost their returns. The problem is what happens when repo rates get unhinged, as happened on the September 16th, 2019. That was late at night when Repo Madness first became public, and then the Fed issued a press release the next day on September 17th, and we started getting all these articles coming out then. Best example of how market players react when their underlying correlations go tilt. Look no further than what happened to long-term capital management in 1998. Also explains why the Fed panicked in response to the repo rate blowing out to 10% on September 16th and instantly implemented repos as well as rushed to launch not QE4. Not only was Fed Chairman Powell facing a long-term capital management-like situation, but because the repo-funded arbitration was abused by most multi-strat funds, the Federal Reserve was suddenly facing a constellation of multiple LTCM, long-term capital management blowups. So if the hedge funds are large enough, their counterparties can start to have big, big problems. No, I'm not going to explain foreign exchange swaps, forward dollar swaps in more detail. Not for free, and there's a bunch of articles I've cited in past podcasts. So that's just enough for this short-term article right now. That's all I wanted to talk about. All the other article links will be in the information and description section. But the bottom line is that there's more evidence that at least one long-term capital management occurred. We don't know the exact time when it occurred, but most likely it occurred around September 2019 when Repo Madness became public. It could have happened before that, a month or two, and because the Fed was talking about it in Fed minutes about repo problems. So the Fed was aware that things were starting to get bad. So something could have happened before then. It could have happened a little bit after then. We may never know the truth about exactly when. But the fact that the Fed is talking about permanent repo facilities and also now loans directly to hedge funds. And by the way, that's only going to drive the public more anti-capitalism, more anti-Wall Street, more anti-business. This is only going to increase the amount of populism towards pitchforks and torches. But the Fed is that worried about systemic risk, counterparty risk, and collapse if they're talking about this. The fact that this even became public is pretty shocking to me. Because in the past, they would have kept this very, very quiet. They did not, in the past, the Fed did not want the currency swap stuff getting out publicly. They did not want this stuff getting out. The fact that this even got out, I'm shocked. Okay, well, I want to thank my over 200 Patreon account contributors, my dozen or so monthly PayPal contributors, and people throw me a tip once in a while. There are plenty of good articles on forward dollar swaps that are written in easy-to-understand terms by Olga Cotaga, I think, from Reuters, from November 2019. You could just look it up and search Olga Cotaga forward dollar swaps. So you should be able to find it there rather than me taking the time to explain it. But the Bank of International Settlements also has literally, they've talked about forward dollar swaps in their December 2019 update in over a dozen pages. So they're very worried about it. It's something that the gold community is clearly not talking about because they don't care. It doesn't fit the narrative that China is doing much better than the US and is going to collapse the dollar. Okay, well, that's enough for right now. And if there's any other stories or if there's any other stories that catch my eye the rest of the day or two, I will come out with something else. But I want to thank everyone for listening, and thank you very much to my Patreon account contributors and my monthly PayPal contributors. It's almost 250 total now with the Patreon and the PayPal, so that's good. Even though I had, I think, about 24 cancellations with the credit card and debit card companies at the beginning of the month.